So using the parallel of 2017, I think the bottom is in. I think it happened today. Now, the other outcome would be the outcome you've shown me.
Yeah.
But my base case is that using the historical parallel, I think we probably put the low in. I mean, Bitcoin's price action, was ugly today. Let's wait and see. Not that I'm not buying, not selling, not doing anything, but it's either your outcome, which is a sharper fall for longer, which is in which case it's fully mirroring the M2 drop, or it does what it did last time, which is it prices in the first part of the M2 drop and then dislocates. And it tends to dislocate the rest of the year because there's more speculative flows in the final year. Liquidity should come in.
Real Vision founder and CEO Raoul frequently highlights the strong correlation between global M2 money supply, liquidity conditions, and the performance of cryptocurrencies. Pal explains that when global M2 growth accelerates, it injects liquidity into financial markets, benefiting risk-on assets like cryptocurrencies. Bitcoin and other digital assets, being highly sensitive to liquidity, tend to thrive during periods of monetary easing or fiscal stimulus, as central banks and governments pump money into the system. While crypto markets often move in sync with equities, particularly tech stocks, Pal argues that in times of extreme liquidity or financial stress, cryptocurrencies can decouple and outperform as they attract speculative capital seeking high returns. Despite recent underperformance in the cryptocurrency market, Pal attributes this to the current strength of the US dollar. He warns that a prolonged dollar rally could strain financial markets and the global economy, forcing leading economies to refinance debts and increase global liquidity. Pal believes this scenario, coupled with President-elect Donald Trump's preference for a weaker dollar, will push the Federal Reserve to reverse course swiftly. He predicts the Fed will inject liquidity through various means to support both the US and global economies. Stay tuned as we bring you insights from Pal's recent interview with Real Vision's Andreas Steno-Larsen.
Hi guys, hope to see you guys at Dubai Token 2049. We have exclusive 10% off the limited super early bird tickets. Click the link below. This pass will grant you access to speaking sessions, networking app, exhibition hall, daily networking drinks, and also included breakfast, lunch, and coffee breaks, all included the package. I love to see everyone there. Peace out.
The dollar is driven by the fears over the new Trump administration and what tariffs mean. And that has pushed the dollar higher and rates higher. And this whole thing is the exact same setup. And you and I have talked about this of the dollar and rates in 2016, 17. With the same set of Trump outcomes and tariffs and the same policies, it did the same thing. The first thing Trump did when he got into office was say, I want a weaker dollar. And he's already said rates are too high. So they're not stupid. They also know that they've got debt to roll, that they also have trade negotiations to do. So my view is they will use the stronger dollar as a carrot and a stick, which is China, you're going to have to devalue your currency unless you play ball with us. But if you do play ball with us, we will inject liquidity into the dollar system. We will lower the dollar. We will jawbone it lower. And you can then stimulate your economy, because the Chinese cannot stimulate right now without risking a breaking of the yuan peg, which they don't want. So I think it's all part of the Trump trade negotiations. And we know that the teams have already been kind of speaking to the Chinese and the Europeans and everybody else. When you go back to Besant, who I know decently well, Scott has made it clear that the dollar is too strong and that he would want a weaker dollar. Lower oil, weaker dollar. They want easy financial conditions because they want to win the midterms. And that's a big thing. Then there's the new guy who's coming in. I can't remember. Felix from Blockworks interviewed him. Can't remember his name. The Economic Council guy,
Stephen Buran.
Yeah, very interesting interview. And Stephen spent half the interview talking about at some point we're going to need a Plaza Accord if this continues, but we are going to have to get the dollar lower. Now, I don't think the Plaza Accord idea is this time around. I think it's probably closer to 2030 that people are just going to go, we can't deal with this dollar. Now, the dollar is structurally strong because the world is 50% in debt in dollars, and there's a shortage of dollars. The moment the US takes liquidity out of the system, it's a game of musical chairs, and it drives the dollar higher. So, people will bid up for dollars. So that's where we are. We've also, as you talk about a lot, we are waiting for the injection of liquidity that comes as the reverse repo redrains back to zero, then probably the end of QT, and then the draining of the TGA. Also in the Fed minutes, sorry, I'm trying to get across a lot here. Also in the Fed minutes, the previous minutes, they had talked about that they're not keen to rebuild the TGA immediately afterwards and have a tightening of financial conditions. So what does that mean? I mean, either there's another way around it, or as you possibly suggested, it could mean QE, which sounds ridiculous now, but who knows? The other thing that this financial conditions is doing is pushing down forward growth expectations. And so it starts to make you think Q1, Q2 might be weaker, and that gives the Fed more cover also to cut rates. So this is from the January GMI. This chart at the top is, let me just get rid of that. This chart at the top is global M2 last time around versus this time around. And global M2 last time around, this time around, it's identical, which is kind of weird. Then we also have beneath it is the chart of the NASDAQ, and that's pretty much identical. So we have a repeat in the monetary conditions, global M2, because the dollar was strong. That's what's pulling back global M2. It also caused markets to readjust. When we look at Bitcoin, we can see the phasing's out, but when you kind of match up the phasing, what happened, it was the 4th of Jan, we had a correction like we're having now, and then Bitcoin went up. And once you match the two, you kind of get a very similar pattern. So what we've got is, and also here's the economic surprises index and the DXY. It's been coming lower. It should drag the DXY, change rate expectations. Julian just put out a tweet this morning about all of that. So everything is here. Fed cuts may change because there's now like 25 basis points priced in. Okay, as a risk reward, there's a decent chance we get something. So it's like all the factors are in play, and whether the market sniffs it out or not, I mean, we got another week until whether we get fuller announcements beforehand or we have to wait for the inauguration and stuff. I don't know.
Julian Bid, head of global macro research at Global Macro Investor, aligns closely with Raoul Pal in analyzing the intersection of macroeconomics and crypto. In a recent post on X, Julian highlighted the dollar wrecking ball, emphasizing how the dollar's sharp rise has significantly tightened financial conditions. He noted that U.S. economic surprises have already begun to decline from their November peak and are expected to weaken further, reflecting the impact of rapid monetary tightening. While this negative trend may persist in the short term, Julian believes it will ultimately set the stage for a positive shift. He argues that the Fed will likely be forced to respond to deteriorating economic conditions by easing rates, despite the current narrative of no rate cuts in 2025. Julian explains that the surge in the dollar and yields during Q4 created liquidity strains, but as weaker economic data continues to emerge, the Fed will have no choice but to act. He predicts that this intervention will cap the dollar's strength, ease rising yield pressures, and alleviate the liquidity squeeze, providing risk assets with the room needed for a strong rally. Raoul Pal adds that this expected liquidity boom could reshape markets, even as inflation concerns linger. He highlights the critical role of global liquidity in driving financial stability and market performance, particularly for risk-on assets like cryptocurrencies. As these developments unfold, both analysts see opportunities for renewed growth and recovery in the financial market.
I don't think liquidity affects inflation, really. I think they're driven by different things. You know, one is debasement, one is the price of goods and services, and I don't think they're necessarily driven by the same things. A lot of this is also the year-on-year base effect. So, and the central banks know that as well, which is why they've been saying, the Europeans, the US, everybody's kind of like, it's going to be a bit wiggly for a while. But overall, we still haven't fully deflated all the housing stuff that's back-end loaded in CPI. So it's going to be heavier than people expect. Also, we're expecting to see economic growth slow down somewhat. The SESI kind of says we're going to get weaker data, but you know, anything now, like the high yields now, plays into inflation in 6 months' time, 12 months' time, i.e. lower. So the answer to inflation is having bond yields what they're doing. I still think by the end of this, inflation will undershoot, not overshoot, because of the weird dynamics that caused by the pandemic. And this lagging of housing and rates being so high for so long, it doesn't affect Microsoft and Apple and Google or whatever, but it sure as hell affects anybody on a variable rate mortgage or anybody who's borrowing money elsewhere in the economy. But it takes time. The other thing that a low ISM indicates to you is that household earnings and corporate earnings outside of the tech are somewhat stagnant still, right? So the feedback loop we haven't had yet, even though the economy has been growing at decent clip. The actual broadening out of economic growth with recycled earnings and profits hasn't really happened. So it's a very late cycle in that respect. The moment it does, it means that the structure of markets changes, small caps start doing better, alt season happens in crypto, it's all the same risk curve. Junk outperforms, all of this stuff starts happening the moment that happens. And we're still not there because of Fed rates, I think. I've just been surprised that the ISM has not followed the forward-looking indicators yet, but it feels like any month now, as you say, it's going to be up 6 index points and another 6, and then before you know it, you're in the mid-50s, and then you'll start to see it. And I think, obviously the Trump administration want that too, because they can't just be tech stocks that are winning. They want Main Street to win as well. And Trump, in the end, is a property developer. He understands the business cycle as well as anybody. I think everybody does. The Chinese, the Japanese, the Europeans, the Australians, the UK. I mean, everybody wants a weaker dollar. One thing I do know is Januaries have this lovely habit of blowing everybody up before the true trend establishes. In GMI, I've been writing for 20 years, I've never made a trade in January because January always gives a conflicting signal. And so the signal now is, oh my God, the markets, rates, this is terrible. And usually what happens is it completely reverses sometime in Jan or Feb, and the market then sets its direction. So I never read into Januaries.
Raoul Pal suggests that Bitcoin and other cryptocurrencies are likely to hover around their current levels for a few more weeks before entering a recovery phase. However, some analysts argue that prices may experience a sharper decline before bouncing back. Tom Lee, head of research at Fundstrat Capital, predicts that Bitcoin's price could fall as low as $50,000 before beginning its upward rally again. In a recent interview with CNBC, Lee described the current 15% drop from recent peaks as a typical correction for such a volatile asset. Lee also notes that the market is still in the early stages of the current Bitcoin halving cycle, which could mean further price declines in the coming week. He forecasts a potential dip to $70,000 or even $50,000, viewing it as a prime opportunity for investors to buy the dip ahead of the next bullish leg. This perspective underscores the cyclical nature of Bitcoin's price action and the potential for long-term gains. Do you agree with Pal's expectation of a steady correction, Lee's prediction of a rapid drop, or do you believe the cycle has already peaked? Share your thoughts and predictions about Bitcoin's future in the comments below. For more Daily Dose Crypto News, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.